74 supervisory institutions and other institutions. So that's quite a impressive gathering. And frankly, it is really a pleasure for me to moderate these events. In fact, sometimes I have to muscle my staff out of the way so I can actually be part of the conversation. And just let's talk about the fact that what's the context here. Over the past few years, we have lived through what was once would have been considered tailed events, a global pandemic, an expanding set of technological innovations such as AI, but also cyber and technological risks, war and geopolitical fragmentation, and rapid tightening in the financial conditions. So I guess what's left? What is striking is not only the frequency of these shocks, acceleration of change, but their interconnected nature. Increasingly, systemic risks are not originating within the financial system itself. How quaint the former global financial crisis is now when we look at where the risks are coming from. Risks are coming from geopolitics, technology, public health, critical infrastructure, and then transmitting rapidly into the financial markets. This raises fundamental challenge for supervisors and policymakers. The pace of pivot is very, very fast. How do you prepare for risks that are difficult to anticipate, hard to quantify, and often outside of your traditional perimeter? In this environment, risk is not only what we miss, but how quickly small shocks can become systemic. So there's a conversation about the difference between risk and uncertainty. Maybe all of those lines might be blurring. At Toronto Centre, our focus is on strengthening supervisory capacity and implementation. Since 1998, we have worked with more than 32,000 supervisors across 190 countries and territories. One lesson stands out. Frameworks and tools matter, but in moments of stress, resilience ultimately depends on supervisory judgment, ability, and preparedness. Our mission is only made possible because of the general support we receive from Global Affairs Canada, Swedish CETA, the IMF, and other valued international partners. Today's discussion will explore risks and how authorities can prepare for extreme but plausible shocks. We are privileged to be joined by two outstanding speakers. I really am telling you, you're in for a treat. These are excellent speakers. Andrea Enria is a former chair of the Supervisory Board of the European Central Bank, brings deep expertise navigating real-world stress events. Nicolas Veron, a friend of Toronto Centre, is a senior fellow at the Peterson Institute, and Bruegel is one of the leading global thinkers on financial regulation and systemic risk. Every time I listen to him, I come out with so many different questions and perspectives. We will begin with a moderated discussion, which will include 3 rounds, and then open the floor to your questions. A couple of quick housekeeping. We have translation available in French and Spanish, so please click on those buttons. And please submit your Q&A early in the Q&A section, not chat. And a tip for those who ask questions, if you write a long diatribe like it looks like War and Peace, I'm not going to be able to read it. Short questions are always much, much appreciated. Okay, the first round is Evolving Risk Landscape. And I'm going to pose the same question to Andrea and Nicholas. So Andrea, let's start with you. Over the past few years, financial systems have experienced a series of shocks that were difficult to anticipate, from the pandemic to geopolitical conflicts and rapid changes in financial conditions. From your perspective, how has the nature of systemic risks evolved, and how should supervisors and policymakers think about resilience? So take about 4 or 5 minutes to give us your thoughts. Thank you.
Okay, thank you very much, Babak, and thank you to the Toronto Centre for having me here. Great to have this opportunity to debate with Nicholas as well. I mean, let me first focus on the positive aspects. Supervisors and central banks confronted with this wave of shocks that you mentioned, coming from all directions, honestly, have shown an unexpected, I would say, even ability to react fast, to be flexible in the deployment of their instruments, release of macroprudential, microprudential buffers, suspension of dividend payments and buybacks, interpretation of accounting rules to avoid procyclicality, deployment of new facility for ample liquidity provision. And what has been for me particularly important to collaborate in a very intense and multilateral basis, bilateral and multilateral basis. Also, I think that the post-crisis reforms, the ones introduced after the great financial crisis, have shown their value in terms of strengthening the banking sector, which is always the core. No? When the crisis comes down to the banking sector, of course, it's going to take almost by definition a systemic dimension. So my first point is we need to maintain and further develop these positive features. No? And sometimes, in the debates I see today, I have some concerns that this strong focus on international collaboration and cooperation and appreciation of the post-crisis reforms is fading away a bit. The second point is that as shocks are coming more and more from unexpected and unpredictable sources, supervisors have, in my view correctly, shifted their focus more and more towards what is, in my view, not so correctly called non-financial risks. No? I say that because for me the point is not the financial versus non-financial. The point is that when the risk materializes in the balance sheet with financial indicators, it's already too late. So the supervisors understood that they need to bolster the internal defenses in the financial institution. So the governance, the board effectiveness, the three lines of defense, the risk controls, and the sustainability of business models. So the shift was on those aspects. I think that was a very good choice. Where are we with that? Well, I think we have had mixed success, to be honest. So we are not there yet. We have thrown a lot of findings at the banks, but sometimes we have clogged a little bit the remediation machine with a bit of a bureaucratic approach. And I think we are still trying to understand what really works in terms of moving the banks in these areas. We also had a little bit of pushback from the industry. So we're still finding our good practices in this field. And the last point on which I want to focus is that systemic risk is definitely morphing into a new dimension. So it's much less manageable within silos of sectors and practices. No, but we as supervisors tend to be, a little bit boxed into our little world of banks, insurance companies, other regulated entities, financial infrastructures, and maybe non-bank financial institutions. So while the risks are taking a much more, interconnected dimension. So what here we are still a little bit lagging behind, to be honest. So the supervisory infrastructure is not yet well aligned with the market and the systemic risk dimensions. The Bank of England started these system-wide exploratory scenarios, trying to connect and understand better how risks would move from one type of institutions and firms to the others via infrastructures through different rounds. I think there are different interesting tools. Other authorities are also deploying them now, but we are still in early stages, and we cannot say that we have, really come to a perfect, well-reliable set of tools in that area. So I would say these are the main points.
Well, Andrea, first of all, you should get an award for answering within 4 minutes and 49 seconds. So thank you. I'm not counting, but just I want to acknowledge and thank you for that. The other thing I wanted to mention to you, as I was listening to you, I'm realizing, wow, you had a really good headline there. Like by the time it hits the balance sheet, it's too late. So in other words, anticipate things as they become available and information and, you know, there's no room to be overly technocratically technical. Like the idea is that you can't have all the information, as you said, collecting reams and reams of data. You got to be able to figure out how to assess all that. So thank you for that. Nicholas, let me pose the same question to you. What are your thoughts on this?
Yeah, first, thank you so much. It's an honor to be here. As you said, it's not our first interaction with the Toronto Centre. I'm hugely admirative of what you're doing at the Centre. And also, it's a great privilege and honor to be on this panel with Andrea, who I think is one of the true heroes of banking supervision in recent times. The quality of banking supervision in the Eurozone owes him enormously. Let me go to your question. I think if I look at the systemic risk landscape at this point, the dominant theme is what's happening in the US. The Trump administration policies are very disruptive from a systemic risk standpoint. And frankly, at this point, we have a number of lights blinking red increasingly fast on a number of different dimensions. Of course, risks about the stock market. Is there an AI bubble? What happens if it bursts? Risks about private credit, risks about crypto, but at a more fundamental level, risks about the rule of law, the quality of institutions, the enforcement of market regulations. There was a very terrifying story in the Financial Times about possibility of government-sponsored market manipulation, which is not going to be prosecuted by the relevant authorities in the context of the war in Iran. And I could go on and on. I think it is a very concerning landscape that will probably have systemic risk spillovers one way or another at some point. It's very difficult, as usual, to make predictive statements in that context, but given the centrality, obviously, of the US dollar and of the US financial system in the global environment, this is quite scary. And I think it dominates the current moment even more than geopolitical risk in a traditional sense. The fact that we have shooting wars in a number of areas pales in comparison with the problems at the center, because let's face it, Ukraine, with all its strategic implications, the Middle Eastern wars, with all their strategic implications, are peripheral compared with the US itself from a financial system perspective. So that would be number one. Number two, of course, is tech, but I would place it well behind. And actually, I agree with Andrea, who by not mentioning tech disruption, implied or suggested that this doesn't dominate the risk landscape right now. I did mention briefly crypto. Of course, there's a lot of chatter about stablecoins and what have you. I think at this point, this is not the number one factor, even though there is huge hype and therefore there's a lot of chatter about these themes. The problem here is primarily integrity. Stablecoins in particular gives opportunity to bad actors and money launderers on a gigantic scale. But here again, I think the problem is not stablecoins per se, it's the quality of enforcement, and especially the quality of enforcement at the center of the system. Looking at the US, where I think we see a very rapid frankly terrifying decline in the quality of processes that until now we had taken for granted. So to conclude on this, and again echoing Andrea, I suspect we'll have too much agreement on this panel, but that's your fault, Babak. You shouldn't have invited us together. The banks are at the center of the system. They remain at the center of the system. Some of the non-banks are quasi-banks, and frankly, that raises questions about regulation. But at the end of the day, the monetary system is centered on the banks. And indeed, when you look at systemic crises, they still tend to be banking crises. Silicon Valley Bank was a very good reminder. We had conference after conference telling us that the next crisis would be from the shadow banking system or whatever you want to call it. No, it was a bank. And that's not a coincidence. Silicon Valley Bank was a major case of supervisory failure. I think supervision, of course, comes to mind when we're talking about resilience, but frankly, regulation as well. There's a huge lobbying campaign of the bank, certainly in Europe, also in other parts of the world, to decrease capital requirements. Given the developments in the systemic risk landscape, there would be a good case to increase, certainly not to decrease, capital requirements. It sounds like a crazy time, frankly, to lower our guard, to decrease the banking system resilience, and particularly because the risks are so amorphous, they can come from anywhere. It is important to have generally high capital requirements as opposed to focus on this or that asset class. I will stop here.
Well, Nicholas, this is fantastic. And see the role reversal? Andrea was talking about how you need to look at the world outside and not put your head on the balance sheet. And you are very much telling us the importance of supervision and not forgetting Silicon Valley Bank and Credit Suisse, which is absolutely true because that was not a systemic failure. It was just a business of supervision and taking eyes off the ball in that case. And you also are giving us an interesting perspective of the fact that, yes, this geopolitical activities are happening and Ukraine, the war in the Persian Gulf and all of that. But at the end of the day, there are much bigger fish to fry here. So thank you for that. That's very,
Well,
yeah,
let me just make some adjustments.
sure.
First, the wars in Ukraine and Iran are not small fish, and I think for the world they are very consequential. But I think my perspective was strictly financial, and
Yes.
from a financial system perspective, what happens at the center is always more important than what happens at the periphery, which is
Okay.
kind of unfair and unfortunate, but it's true. The other point is about Silicon Valley Bank. I actually view it as a systemic event. I think it was a systemic crisis, even though
Right.
it didn't last very long, and I think there is quite a bit of academic consensus on that.
Yeah, yeah. So the system came together to deal with that in that sense. So thank you for that. Let's go back to and Andrea. I guess now you've been called a true hero of supervision. So the second round is going to talk about are supervisory and regulatory tools adequate? So Andrea, during your time leading the European banking supervision, the system went through several major shocks, including the pandemic and periods of market volatility. Now, when you look back, how well did the supervisory toolkit perform, in particular considering such things as stress testing, capital buffers, and supervisory judgment in helping banks navigate those unexpected shocks? Thank you.
Thank you. Well, I already mentioned that I think the supervisory toolkit adopted with the post-crisis reforms performed well. In my view, the polar star should always be supervisory judgment, right? I mean, the shift from a supervisory approach based on compliance, where we are basically boxed into ticking boxes and constrained by checking compliance with the rules, is always inhibiting supervisors to take the actions which are necessary in light of increasing risk. No? So having ample room for supervisory judgment, being able to challenge risk-taking by banks, by supervisory institutions, is, I think, one of the key ingredients that has made the supervision stronger and better. And the fact that, let's say, the SSM was basically built, the single supervisory mechanism was built after the great financial crisis, to some extent put these elements into its genes. No? And it is important also that supervisors are always alert to their supervisory culture so that they understand how, irrespective of the rules you have out there, you maintain this leeway and focus on supervisory judgment. As always, however, there are lessons and areas in which I think we should debate in the supervisory community and try to sharpen our tools and do better. The first point, I would have three areas and one appendix, if I may. On the three areas, quickly, stress test is the first one. This is a very important addition to the supervisory toolbox after the great financial crisis, but we are still a little bit too centered on the reassurance function that was introduced with the SCAP, the Supervisory Capital Assessment Program in the US. So trying to reassure the public that the banks have enough capital. So this has positive elements. It has helped calibrating capital buffers. It has increased the transparency. Supervisors have increasingly been doing sensitivity analysis, but we miss a bit the analytical capability of seeing what would really rock the boat at individual banks and help preparing for those events. So I think we should work more on that. The areas which I think are more delicate are the difficulty combining capital and liquidity dynamics in the current stress testing toolbox, which is mainly capital focused. A point that Laura Valderrama from the IMF raised in one of the recent contributions to the Financial Stability Forum of the LSE. and the use of market indicators, I think also. When you have a stress event, market starts focusing on mark-to-market dynamics and indicators. So they shift from balance sheet indicators to mark-to-market indicators. And I think we are not yet alert to that. Second point, I think that we have a lot of work has been done after the crisis on resolution planning. Recovery planning has remained a bit the Cinderella of the tools here. So there has been a work done, but to my experience, at least in the jurisdiction I've seen in the EU, it has been a little bit too much a sort of compliance exercise, not easily operationalized. Now this is shifting more towards dry runs and really testing how banks would recover in a crisis. And I think we need to do more on that. And for instance, focusing more on liquidity stress and deposit outflows rather than, and also access to central banking facilities rather than on capital and capital shortfall. Buffer usability is the third point I want to raise. This remains a challenge. I think it has been good that when the buffers have been released, banks have not, gone in the knee-jerk, spike in risk aversion as it happened pro-cyclically after the great financial crisis. So the release of buffers was positive, but still banks were reluctant to dip into the buffers, to really use the buffers. And why is this the case? I think that the issue is the way in which the so-called maximum distributable amount, so the constraints, the automatic constraints on bonus payments and on payment of on dividend payments and payments of additional tier one capital investors are the key ingredient. I mean, this is something that banks didn't want to go into. They were really scared of receiving a lot of stigma from investors. So these are elements on which we need to reflect. There are proposals out there, but we need to reflect further. And the last point, the appendix, let's say, because it's not a supervisory tool, but we have had is on resolution. I mean, we have had substantial progress on resolution, but I think the 2023, the spring 2023 events cast a shadow in terms of the trust that everybody has on the workability of resolution tools, especially when you're talking about globally systemic important banks. And I think we need to restore trust in the resolution going forward. Thank you.
Thank you very much for laying these out. And you started your talk about supervisory judgment. And I remember when I came to Toronto Centre, one of the very first things that the former chair of Toronto Centre was talking about is that how we need to really make sure that people understand why they're supervised. So supervised judgment is actually critically important here, and you laid it out. And both you and Nicholas in different capacities talked about trust and integrity. So I think that's all very, very well put together. So let's go and move to Nicholas. And I'm also encouraged to see questions coming in. So I think we're going to be in a treat for a Q&A session. Nicholas, the regulatory reforms after the global financial crisis clearly strengthened bank resilience. However, there's always the concern that regulation ends up preparing us for the last crisis rather than the next one, looking at the rear view mirror. From your perspective, what are the biggest gaps in the current regulatory architecture today? Thank you.
That's a good question. I'm not sure. So it's a bit early to judge Basel III, of course. If we include the end game, it hasn't been fully implemented yet. When I look at Silicon Valley Bank and at Credit Suisse, so Credit Suisse, as you probably know, got some exemptions from the Swiss supervisor, which in retrospect look really foolish, but they were not, failures of the Basel framework. They were a failure of FINMA, if that's the right word, certainly mistaken decisions in retrospect. Similarly, at Silicon Valley Bank, I think the supervisory failure of the Fed system in particular, but also correlatively of the FDIC and of the California state regulators, has been well documented. I view it more as a case of supervisory failures than as regulatory failures. So if I look at the regulatory framework of Basel III, on those two important crises of 2023, which remain the most important crisis of the last almost decade, or certainly of the last half decade, they point to supervisory problems more than to regulatory shortcomings. And I think with the implementation of Basel III Endgame, which is finally coming, we will have a framework of regulation, certainly at the global level, that there's not an immediate need of reform, but which is very much in need of enforcement, including the element of supervisory judgment that we have already talked about. Now, you also have national gold plating or reduction of gold plating. And here, of course, what I think is particularly important is the US decision taken last year to reduce the supplementary leverage ratio for the largest banks from a level which was quite unique in the world, given its stringency, to a level which is more aligned with the Basel standard. And I'm not sure that's a wise decision, but it's not a breach of international commitments or understandings in Basel, at least for now. We'll see how that situation develops.
Okay, thank you. That's very well put. So there's still a lot of things to think about and progress. Or sorry.
But let me add, sorry, is that it's a sensitive topic in Brussels where I sit today, but the EU is still not compliant with Basel III. So we will look forward to the next regulatory consistency assessment program, but it is very likely that they will again find the EU materially non-compliant or even simply non-compliant with Basel III, given all the exemptions in the EU framework. And I think that's a concern for EU policymakers, or at least it should be.
Yeah. Okay. No, thank you for that. So now we're in the third round, preparing for the unthinkable. So Andrea, I'm going to pose this question to you. Supervisors today are increasingly dealing with risks that originate outside the financial system. And we talked about geopolitical tensions, cyber threats, disruptions to critical infrastructure. So bring it back to supervision. From a supervisory standpoint, in your view, how should authorities prepare for shocks that may originate outside the financial system, but could quickly threaten financial stability? Thank you.
Thank you. So I already mentioned the emphasis on governance, internal controls, and the like, and this remains for me the key area of focus. No, when you don't know and you cannot control the sources, you need to make sure that banks have strong internal safeguards. But let's say supervisors, to a large extent, are already trying to tackle these external challenges, and they have identified geopolitical risk. For instance, the ECB has recently identified geopolitical risk as their top supervisory priorities. I understand that this year the ECB is running a reverse stress test exercise on geopolitical risk. So each bank will have to design a scenario that will put it under great stress in terms of geopolitical developments. Sanctions regimes also, I mean, we had a sort of learning by doing after the Russian invasion of Ukraine. We are already seeing how to operate the machine. It's not an easy one. Sometimes you have conflicting signals coming to the banks from different supervisors. So it's quite complicated, but we have been able to manage numerous waves of European and international sanction packages. Operational resilience, penetration testing, red team exercises, stress tests on market infrastructures, now a new focus on critical third parties are all things that I see more and more at the top, at the front of the agenda of supervisors. So for me, it's not an issue of not having enough focus on these topics. The real issue is, in my view, skills and budget. So it's clear that these are areas in which the budgets of supervisors are under stress. You don't have enough resources of the nature you would need. So you need to go much more for supervisory training, upskilling your staff, and trying to build the expertise that you lack. In terms of other points on which I think we should focus our attention is the most important in my mind is the impact that geopolitical shocks would have on international collaboration between supervisors, resolution, and central banking authorities. What I've seen working very well, for instance, also during the spring 2023 turmoil, was the close collaboration that we had internationally. Daily contacts, joint analysis of elements of stress on major institutions. I mean, these worked extremely well, to be honest. We know, on the contrary, I know firsthand the damage which is done when during a crisis, each supervisory authority starts closing itself and working in its own jurisdiction for its own interest. That's what happened during the great financial crisis within the European Union. Jacques Larosière mentioned chacun pour soi policies, adopted by authorities in the European Union. So if you have a geopolitical shock, which type of mode will we be in? How can we make sure that we will choose a collaboration mode more instead of a chacun pour soi type of interaction? And also the new focus on competitiveness, which is affecting most supervisors, that you should deploy regulatory and supervisory levers to improve the competitive position of your industry, to some extent is by construction a little bit in tension with the collaboration that you need in times of stress. And another point that I want to mention, which is to me very important, is the coordination amongst tools. So I think the tools that supervisors, resolution authorities, central banks have probably are in a relatively good shape. I mean, the big question is, are we able to operationalize them in a smooth continuum from supervisory tasks to, central bank liquidity assistance to resolution and smooth exit from the market? To be honest, I think that the loopholes in that space remain. We need to make sure that we have a greater integration of this function and better maybe exercises, dry runs, testing of how these tools would work in practice. I'll leave it here. Thank you.
That's great, Andrea. I think this is very, very useful as you're laying out really a whole kind of a bit of a playbook and how various things are connecting. And I'm reflecting on what you said about training and capacity building. So our experience sometimes when we go to some jurisdictions is they want us to give them the Canadian model, Italian model, some other supervisory model. But I'm reflecting on what you're saying and what Nicholas was saying, the problems in the core versus periphery and all of that. Answers are not in one system. You really need to understand your own system. You need to understand your own risk. You need to be able to cross-collaborate. Just open your mind and be intelligent in terms of looking at the risks and really trying to understand, go to the root of it. In a sense, that's what you're saying, as simplistically as I put it, but it's really, really critical. Think for yourself, supervisory judgment. These are the things that I keep getting from you and also from Nicholas in terms of trust and integrity. Nicholas, thank you. Let me give you the last structured question that we have, and then we're going to try to open it up for Q&A. Okay, so you're a big thinker. I always learn from you, so it's a big challenge for you. Looking ahead 5 to 10 years, we may see greater geopolitical fragmentation, technological disruption, and new forms of systemic risk. That's my assumption. What kinds of vulnerabilities or shocks do you think policymakers may still be underestimating today as they're preparing themselves? Thank you.
Well, prepare for the unthinkable is a mantra here. I think the geopolitical events that we mentioned combined with the domestic political developments in the United States, in a way, I already answered your question. I said what my current obsession is in terms of financial stability, and it's very US centric for reasons we can discuss. But, essentially, you have three major financial systems in the world. You have, in no particular order, US, China, and Europe, and then the rest is less critical from a global perspective. China is extremely controlled. So we can discuss at length the features of the Chinese financial system, but I don't expect financial stability problems of a disruptive and systemic nature emerging from there anytime soon. I think the European system in general has gone through a lot of turmoil in the 2000s and 2010s and is now more resilient as a consequence, even though there are lots of challenges that we can go into. By comparison, in the US, we're at a different point of the cycle, whereas the previous major crisis was around 2008, Lehman Brothers, the great financial crisis. There was a big wave of reform at the time, but this was already 2 decades ago, and we're in the cycle of complacency. Basically, when people forget about the importance of obsessing about systemic risk and think that by deregulating the system, you will unleash forces in the economy, drive the economy hot, and get a lot of short-term rewards. And we know from long-standing history, repeated cycles, that this leads to no good. So that's what for me, is front and center. Now, how can regulators and supervisors address that? Well, first, it's difficult. And second, I'm afraid general capital requirements are a big part of the answer. That's a very blunt tool, but that's the tool we have to prepare for unexpected risks that we can precisely not factor in through a very specifically calibrated coefficient.
Very well said. And at one point, I heard this time is different. Resist that urge to try to think that we can just work our way out of a crisis by not thinking about issues.
Having said that, I will say that the financial system has worked very well through a number of crises that have not triggered systemic turmoil, even though they might have. If you think of energy crisis, geopolitical shocks, the pandemic, the system, sometimes with help from public policy, sometimes just on its own, has been able to absorb a lot. So I think we have a lot of things that work, not just supervisory attention, but also market mechanisms, but that should certainly not lead to complacency. Sorry for the interruption.
That's great. Yeah. So now let's go to the Q&A. I think we have a good, robust set of questions, and I'm going to pose them to each of you. Hopefully, we can get through them all. And so let's start with Adeline's question. She's asking, what are the key skills that financial supervisors have to build that are valuable in the era of extreme risks, basically to prevent surprises? So I'm going to give this to Andrea, because you've been talking about a lot of different things about, work with your peers, look at things. But what would be your very concrete suggestions to a supervisor sitting at a desk somewhere in Zambia or in Malaysia, trying to, squeeze your wisdom on this one in a very succinct way?
Well, I may surprise you here, but I think in the last 12 years after the crisis, 15 years, we invested a lot on technical training of our supervisors, right? I mean, we have a hugely complex regulatory framework, so we need to become good in terms of understanding internal models, sophisticated tools, structured products, stress testing. I think we have a little bit underestimated the need to train our supervisors in softer skills in terms of engaging with boards, persuading boards, key people in the banks to own the problem and resolve it internally. And I think we should train our supervisors more in that respect. I think sometimes when I see, I'm now working as a senior advisor, so sometimes I engage with the banks together with the supervisory teams, with more junior supervisors, and I see that they are a bit green in terms of, being able to move the management of the banks in the right direction, convince them that they need to take ownership of the problem. So I think I would deploy some training budget, let's say, also on soft skills, because I think we better need them.
Great. Well, Andrea, you've become a marketing agent because we do a lot of that soft skills training. Thank you for putting a plug on that. It's so important. You can have all the information in the world, but if you cannot brief up, you cannot convince the minister or whatever on your way. I mean, what use is that? Thank you so much for that. That's absolutely important. Matthew's asking, I'm going to give this to Nicholas. What is the risk that institutional credibility itself becomes the next systemic vulnerability?
I think I already addressed that to a certain extent with reference to the US. It's easy to underestimate the extent to which trust in the system is related to trust in the guardians of the system, and those are the supervisors, securities supervisors as well. We can call them supervisors, regulators. Different places have different pieces of vocabulary for that. But basically, all these financial authorities dealing with markets, dealing with anti-money laundering, dealing with prudential, dealing with conduct, which are kind of the invisible infrastructure that allows markets to function. And if these fail in their duties, if they become soft, if, for example, the SEC doesn't prosecute market abuse because the market abuse comes from the top of the US government system, then the system is at risk.
Thank you for that. Ugo is taking it. No, sorry, do you want to add something?
On this point, there was this paper by the IMF in 2010, I think, that was learning to say no, no? So the ability of supervisors to say no. I think we have also maybe paid too little attention to the independence of supervisors. No?
Yeah.
I understand that regulation, of course, is under a lot of influence. Parliaments can, intervene in that space. But on supervisors, you really need to protect your independence, your judgment, and I think that we need to make an effort now that maybe the pendulum is swinging a bit back to protect this aspect of our frameworks.
That's absolutely critical. In fact, our last webinar really talked about supervisory independence in the current era, right? And another thing to think about, some of us who are in, well, those of us who are in the sort of developed jurisdictions, we take it for granted the protections that a supervisor has. Many of our colleagues in developing countries, in Latin America, in Asia, elsewhere, if there is a problem of failure, they themselves are personally liable, right? They themselves can go to jail, or they themselves. So this really puts a very difficult a cloud over all of this, right? So like some of these problems are absolutely very practical. So Andrea, I'm going to come to you on this one. Ugo is a contrarian. He wants to challenge. He says, I'm challenging the idea of increasing capital requirements further. The recent bank failures were not caused by insufficient capital. There is a need to shift supervisory focus from capital/solvency to liquidity risk, especially given the shortening of the settlement cycles. What are your views on this?
Look, I mean, again, I'm not arguing for strengthening or beefing up the capital requirements. My argument there would be that so far I've not seen any compelling evidence. Actually, I've seen no evidence whatsoever that the current levels of capital requirements provide an obstacle to lending, growth, or anything else. So let's say, for the moment being, I'm sitting in my place and I'm not moving. No, I don't see any reason for changing what we have put in place after the great financial crisis. I think it's in a decent place. It was calibrated in a modest way against the advice of many academics that were arguing in favor of much stronger capital requirements. For the moment being, I don't see any evidence to move in either direction. In terms of liquidity, again, I don't think it's an issue of requirements in my view that much. It's an issue more of supervisory focus on liquidity issues. And as I mentioned before, I very much agree that this is an element of weakness. We know that, for instance, the LCR has not captured many of the differentiation in deposits that we have seen at play during the spring 2023 turmoil, uninsured deposits, the behavior of large depositors. So I think we need to do more work there, and also do supervisory work, as I mentioned, on the interaction between capital and liquidity. Because what we have seen is that when equity prices, for instance, go below a certain threshold where capital levels are depleted or at risk of depletion, there is an immediate impact on outflows of deposits. And this is something that we have not modeled into our supervisory framework. So we need to think about that much more.
Thank you for that. Nicholas, I see there's a courageous person identifying themselves as anonymous. So I'm going to ask you a question from this individual. Do you think the global financial system today is fundamentally more resilient or just more complex and therefore harder to understand? So wondering what your views are on this.
More resilient than what, or more resilient than when? I think this is a constantly evolving landscape, I'm not sure how to interpret the question, to be honest.
Okay.
I think the global financial system is certainly hard to understand, but that's why we need international, joint work, as Andrea, I think, eloquently put it, not just during crisis, but also in preparation for crisis and in terms of ongoing oversight of exposures and risks. I will say that, at least the central bankers of this world have institutions, the Basel cluster, that allows them to do that. Whether this institutional framework is completely adequate, we can discuss, but it is very helpful and valuable. So not undermining it as a first step, do no harm. But I think we need also, better instruments. One of the things I do, which is not the core of my work, is that I'm an independent non-executive board member of a trade repository, which is the one operated by the GCC. And those of you who remember those G20 reforms of the early 2010s will remember that there was a reporting mandate that was imposed on the industry at some cost, not a huge cost, but a material cost, to report derivatives transactions, so that financial stability authorities would have the kind of almost real-world picture of derivatives exposures on a globally integrated basis. The good news is that the infrastructure for this has been implemented, but the bad news is that the system doesn't work because this is not typically in the remit of central banks, and we frankly lack the institutional infrastructure at the global level that would allow this technical capability to translate into the actual capacity to monitor risk exposures as they form. And I think that's a big policy failure that requires actually some forensic analysis.
Excellent. Well, for a question that you didn't initially understand, your answer is actually very understandable. Thank you for that. And I happen to have been in Toronto in 2010 when one of the G20 meetings were being held, and it was quite a raucous event, like lots of violence and all that. But that was a very important discussion at that time. I do recall that. Let's go to you, Andrea. Interesting question here. Question that brings in sustainability from Lynn. Do you believe, well, the question is, are those in supervisory roles sufficiently knowledgeable about the so-called non-financial issues to ensure a livable planet and a sustainable world? It's kind of an interesting question at this time and day, because as you recall, sustainability was a very important issue, SDGs, for many, many, many years until like early 2005. I'm not saying they're not important anymore, but those are not things that we hear as much. But what is your view on this? Did we, during that period where SDGs were a big issue and NGFS, for example, was formed and others, did we make progress to make sure that supervisors understand these non-financial issues as they impact the financial sector?
Well, the first point I want to make is that when I was at the ECB and also here at the Bank of England, there is a very large set of young staff that is super passionate about these issues, very willing to learn and to really focus on sustainability issues. And that's a real wealth for supervisory authority, a real resource for supervisory authorities, I would say. I think there is awareness that this is an important element of risk that we as supervisors cannot neglect. I mean, would be the dereliction of duty. The ECB has done a lot of work in this area, has set out clear expectations, and has designed, has pushed firms to, design plans to comply with these expectations, has also started deploying sanctions in some cases where the firms were not respecting their own commitments. The Bank of England is also has issued later last year a set of supervisory expectations moving in the same direction. So I think that's an area of work that needs to continue to be high on the agenda of supervisors. Again, do we need? Do we have a skill gap to fill here? Yeah, probably so. Of course, this is a frontier topic, but I see a lot of supervisors that are very willing to upskill and perform tasks in these areas.
Yeah. No, actually, I find your answer quite optimistic here. Toronto Centre was one of the very, very first organizations that dealt with incorporating SDGs into the supervisory curriculum and capacity building, even before the international standard setters validated issues like climate. But I do also think, this is my personal view, that we went through a bit of a flashy period where these things were virtue signaling for some. But now I think there's that quiet confidence built on things that work, things that may not have worked, and the work is still very valid. I mean, climate change has not changed, right? It's still very much an issue. So thank you for that. Nicholas, there's a big picture question here, and I'm wondering maybe you can take that because you are not in a supervisory institution where you can look at it from outside. The question is, in an environment of extreme uncertainty, supervisors cannot prepare for everything. Where should they deliberately choose not to focus? How do you make that call? So this kind of reminds me of what Andrea's reference was to the IMF paper about how to say no. What is your view on this? What's your contribution to this question? Thank you.
I have bad news for the person who has a question. Supervisors have to look 360 degrees. They have to look at all dimensions. They need to keep their mind open to any direction of risk. The risks that are the best identified are generally not the ones that will generate the next crisis. So you have to be a bit paranoid in this line of business. And therefore, the idea of saying, okay, I have limited resources, here is a risk category I will just not work on because I need to cut some of my activity is probably not a very good idea.
So maybe that's why the person was anonymous asking that question. And I think you're right. There's no time to take a coffee break in that sense. You have to always keep looking at it. Andrea, let's go.
I mean, of course, on the risk horizon, the horizon scanning, the risk, I think that's absolutely right. What the supervisors need to be good at is to prioritize remediation. So you cannot throw all the things to all the banks and expect that they will be fixed within the next supervisory cycle, right? So you need to be very, very, very sharp in focusing your efforts on individual banks and say, this is the top priority. I want you to deal with that, and I want to deal with that within a certain time frame. I mean, being effective in the way in which you focus your resources and you ask banks to remediate, I think, is key in our job.
Okay, well, that's great. Thank you for that. And now then let me pose this question to you, Andrea, from Ewald. I'll just read it as is, and we can try to understand where the thinking comes from. She is asking, do you think supervisors adequately stress test the tools they have?
Well, to some extent, I mentioned that. I think that we are not yet able to combine different tools and to stress test different tools. So we have capital requirements, we have liquidity requirements, but then when you go into a crisis, in a stress, you have this connection between the capital metrics and the liquidity metrics that we don't capture in our exercises. And I think that's one of the analytical challenges that supervisors have, to be able to understand better how the different tools interact. And it's not only for supervisors. As I mentioned, if you are doing a recovery plan and you stress in a dry run, you need to understand how your actions would interact with the central banking action, would interact with the resolution authorities action, and with other supervisors' intervention, and try to see how this would work out. And we are not doing that yet as we should, I think.
Okay, one of the participants is talking about some echoes in the voice, so I apologize too for that, but we're doing the best we can. Nicholas, someone's sort of trying to maybe question you about your conclusion about SVP failure. The question is, Nicholas, it's actually you're mentioned by name. Why do you believe SVB failure points more to supervisory failure versus regulatory failure?
I think it has been reasonably well documented. There were flashing signals about business model risk and interest rate risk in SVBs that were identified by supervisors at the bottom of the organization, of the supervisory organization, and that didn't make their way into supervisory decisions when they should have. There has been a lot of analysis in 2023. I think one of the particularly good pieces of documentation I found was the testimony of a former general counsel at the Federal Reserve, whose name I currently forget, but it's easy to find on the congressional website. I think it was a Senate testimony in late May 2023 that went into the details of the Fed's internal organizations that dysfunction in terms of leading to relevant supervisory action in a timely way. So I don't think I'm saying anything particularly controversial here. Of course, supervisors tend to defend themselves when they're, blamed for supervisory failures, and the Fed has, to a certain extent, done that. But I think there has been wide recognition that the system didn't work properly. I remember interviewing in a public podcast with a webcast, which is still on the Peterson Institute website, Dan Tarullo, who used to be in charge of these issues at the Federal Reserve in a previous cycle. And I encourage all of you who are interested in this issue to watch that particular video.
Thank you. Unfortunately, we're going to have to leave a few questions unanswered. They're all very, very interesting. And one of them caught my eyes. Should supervising regulators be remunerated more than lose more when they fail to have spotted risk? I wish financial advisors would be held up to that, but I think we can let go of this question for the moment and can talk about it later. But all these questions that are...
No, actually, it's a good question.
You want to take that on?
I mean, obviously, the answer is very different depending on jurisdictions. The idea that you should punish supervisors financially for supervisory failure strikes me as crazy, but the question of remuneration is very important, and it echoes many of the things that Andrea had been saying about capability and honing the skills and not reducing the budgets, because we need to devote those resources to watching for prudential risk. It's generally a good investment.
Good. So at this point, I'm going to try to bring this session to a close as we're reaching the top of the hour. First of all, I want to thank to our excellent speakers for such a rich and candid discussion. I took a few notes here, so let me see if I was able to condense it to give it some sort of a justice. I believe what stands out is that supervision in today's world is really no longer about operating within well-defined boundaries. It does demand integrity, sound judgment, and the confidence to act under uncertainty. I also think it requires us to break silos. We heard that from Andrea, to connect risks across institutions and sectors, and to look beyond regulatory perimeter to understand the broader geopolitical and economic forces shaping the system. I reflect back on what Nicholas said about the big fish, small fish. Yeah, there are major issues. Let's not forget the challenges that the core is facing versus the periphery. They're all interconnected, but let's not take our eyes off that. And if there's one takeaway, it is that the unthinkable becomes manageable when supervisors are prepared, connected, and willing to act early. I'm tying that back to Andrea's point about supervisory judgment and capacity building. And also, one last reflection on what Nicholas said. Somebody was asking earlier about, well, when can we say no? Well, we may never have the luxury to say no. You really have to be able to look at all these various risks and have your own way of ranking and prioritizing. So I really enjoyed this conversation. Thank you so much to both of you. We're going to publish this webinar on our website for everyone and also take bits and pieces of it, incorporate it into our training programs, really, really benefit from it. And thank you very much for your time and goodwill. Take care.
Thank you.